You gotta be flipping my flapjacks. We are in busy times, folks. We got earnings after earnings hitting for many of the biggest companies in the world. I'm trying to keep you guys up to date as well as I possibly can in regards to all this stuff going on, my perspective, opinions. A lot to get into in this video here today. Amazon just came out with earnings here in the past hour. Stocks moving up significantly. Congratulations to every single person out there that's an Amazon shareholder. I don't care if you got a share, 10 shares, 1,000 shares of Amazon. Based upon what I have in the public count tomorrow will probably be, my guess is anywhere is between a $30,000 and $60,000 day. If the stock goes up $30 a share tomorrow, we'll be up $46,000 on Amazon stock. So we'll spend some time talking about Amazon. Then I want to talk about big tech in general. We have 6 of the 7 big techs have now, the 6 of the 7 Mag 7s have now reported. I want to share my perspective and opinions on who looks the strongest and weakest of these companies. Okay. From there, I'm going to show you my entire possible buys watch list and talk about which stocks I view as the best opportunities and which ones I'm waiting on. So that should be fun to get into. From there, I want to react to this video from 57 minutes ago. Amazon's magic number is AWS growth. Looking forward to reacting to that one. I want to react to this one, Gene Munster, on his takeaway from the Meta's investor call. And then this video here, looking forward to reacting to this one around Meta and the fast money traders sharing their perspective and opinion. And I thought this would be a great time to talk about Meta. Obviously, with the big downward move, a lot of people are looking at Meta stock and they're like, wait, is this a great deal right now? Is this like easy money? Is this kind of like all the money's been made in Meta stock? Those sorts of things. So yeah, I want to get into all that. There's one thing and one thing only I need from you guys. If you could just hit that little thumbs up icon, that would mean the world to me. That's all I need from you. And thank you every single person that's already done that. Additionally, if you're not subscribed to the channel, you might want to subscribe. We just hit a new all-time high subscribers in the history of the channel, so I appreciate y'all for being here. A pinned comment down there today if you want access to my entire library of premium courses, access to my private Discord chat, exclusive weekly videos, all that good stuff. That'll be pinned comment down there. We're now up to 2,735 members. I'm seriously considering closing the group to new members in either November or December, and then reopening at some point in time in 2026, because it's just been overwhelming. Like back-to-back days, we've had over 120 applications to private group. Usually we have 15 to 25. And I don't have a big team that works for me. I only have a few people that help me run the private group. I have my developers that work on 1000xstocks.com, right? And new features and things like that, right? I have like one person that helps me with Patreon, one person that helps me with the YouTube clips channel. I don't have like some massive team. I got just like a very small team of probably like 10 people or less. So yeah, like the private group, the demand's been overwhelming. So I might shut it down to new members next month or in December. So if you want in there before I do that, there'll be pinned comment down there. Okay. Alrighty. So amazing's on. Let's talk about Amazon first and foremost. Okay. So when it comes to Amazon, I'm going to show you their report in just a moment, but let me just put it simple. Okay. You want the 5-second answer? Amazon's a buy. Amazon's a buy. And the most important metric that Wall Street really cares about, AWS growth, is accelerating for the company. We've now seen it several quarters in a row of acceleration of AWS growth. We're now into the 20s when it comes to AWS growth, which is significant. Remember, AWS is by far and away the biggest cloud company in the world. So when we're talking about that business is growing 20%, that's substantial. Big dollars, right? It's one thing if you're a little cloud company just growing and like, oh, we grew, revenue 35% last quarter and you got like these little small numbers. Okay. When you're Amazon, when you're the big dog and you're growing 20% plus, that's huge. So, just something to kind of keep in mind there. If they accelerate that Amazon Web Services growth, that AWS growth to the mid 20s, you'll see Amazon with a 3 in front of it quick. So keep that in mind. If they could go like 24, 25, 26% AWS growth, you'll see a 3 in front of that stock. That, there's so many businesses inside Amazon that matter so much to that stock, but Wall Street cares about AWS more than anything out there because it is a profit machine business for them, right? So yeah, Amazon's looking good. Now, as far as big tech in general, the Mag 7 specifically, right? When we look at this overall, so like Tesla, for instance, their main issue is their revenue growth is really slow, and then their earnings per share is going down quite, substantially, right? Even if you look at like adjusted EBITDA, all those sorts of things. So there's no debate. Tesla's by far and away the weakest, but obviously people are really excited about potential long-term things for the company, right? Now, when it comes to Meta, the revenue growth is insane. Like Meta's got the second strongest revenue growth of any of the Mag 7s. The only company that's growing more rapidly than Meta on the top line is guess who? NVIDIA. That's it. And so Meta's, in a great position. The issue with Meta is Zuckerberg's really, really running up those those numbers when it comes to expenses, right? And let me show you an illustration here from the private Discord chat. I posted something very important last night here in the meta chat that I want to show you. Right here, okay? I posted this 1:28 a.m. I was still up. I posted this just so you guys could kind of see this, right? So revenue growth versus cost growth last 3 quarters. Revenue growth for Meta here was 16%. Cost growth was 9%. Revenue growth 22%. Cost growth 12%. Phenomenal, right? Now, revenue growth continues to accelerate quarter after quarter, now up to 26%. That's amazing. But look at the cost growth was out of control this quarter, 32%. So what we need to see in future quarters is they have to get this number under control and get that revenue growing at a faster clip than this. If we can do that, then you'll see Meta $1,000 next year. So that's the big thing that's very, very impactful there, and something you guys got to keep in mind here. Now, when it comes to Google McDougal, very solid B+ income statement from Google here, right? They also are having, expenses are getting a little high for Google as well. Like, look at G&A for the company. G&A roughly doubled year over year, so that's a big number there. R&D, research and development, that was up huge as well. Obviously, they're spending a lot because they think they're going to be able to make a lot of money in the future. But Google McDougal, definitely expenses high. AmazingZone, B- grade for AmazingZone here today. Total sales growth looks phenomenal. They grew revenue $22 billion roughly year over year, which who else can do that? That's insane, right? But the main issue when it comes to Amazon is they had this other basically expense here, about $2.8 billion that hit them. So technology and infrastructure was a pretty high number too. That was up about $6.7 billion year over year. So they ended up getting a B- grade in the end from Amazon. Mr. Softy shows why they're one of the kings, right? Grade A income statement here, phenomenal numbers. And then Apple, phenomenal numbers. They were also a grade A as well. They barely missed an A+. If they would just had faster revenue growth, I probably would have given them an A+ overall for Apple. So good numbers out of Apple, or I should say great numbers out of Apple, great numbers out of Microsoft. And then the others are solid, but they're not like amazing, right? And then I'm sure we'll see amazing numbers out of NVIDIA, right? So the moral of the story is, who impressed the most this quarter? Listen, it depends on if you're looking at it from an overall standpoint of like profit growth, margin growth, those sorts of things, or who impressed the most as far as revenue growth. Who impressed the most as far as revenue growth, that crown would go to Meta, right? 26% revenue growth. With how big that business is, to be reporting 26% revenue growth in this environment is unbelievable, right? Like, people didn't think that company could still be reporting this sort of growth. Like, that's insane. The number 2 company that impressed the most when it comes to revenue, I would say, is Amazon. Amazon, the fact that AWS is now growing in the 20s again, phenomenal. Who impressed the most as far as an overall income statement? Though that would definitely go to 2 of the kings of Mag 7, right? Which is Apple and Microsoft. And then we're going to see the last king of Mag 7 report in a few weeks from now, and don't be surprised if they report an A+, right? If they don't actually report an A+, don't be surprised if NVIDIA stock goes down. Keep that in mind. Like, NVIDIA has to come in with like this perfection all the time now to continue to go up. So that is just something to kind of keep in mind there, right? No, my possible buys watch list here. Which stocks am I most excited about, least excited about, all that good stuff, right? Okay, so let's just start it at Cava. Cava first off, okay? So when it comes to Cava, this stock has been wrecked. I mean, look at this stock. Year to date down 53%. Unbelievable. And it's not the only restaurant stock that's had trouble overall. There's been plenty of them if we pull up a year to date here. So let's compare them against CMG, which has been going through it also. Let's compare them against Starbucks. And let's pull up my beautiful cake. I love cake. Should I pull up Texas Road? I'll throw up Texas Roadhouse also. Okay, that's been a great company over the years. And then, you know what, let's throw up, we could put up McDonald's, okay? Let's put up McDonald's as well, okay? And obviously these companies all compete in a different way. Now, McDonald's has actually been the best performer year to date. The whole sector has, how do I put it nicely? It sucked, okay? The whole sector is bad. This has not been, like, if you're looking at it from a short-term perspective, like 2025 has not been a year for food-related companies, okay? It doesn't matter if you're quick serve, if you're a sit-down restaurant. They're all bad. I mean, the only 2 that are gains this year, the only 2 you have made money in this year, right, is McDonald's and cheesecake with a 1% and a 3% gain. That just shows you how weak this sector is overall, right? And it definitely shows you who's the most quality in the space as well, right? McDonald's is always the most quality, even though their food's not the most quality, right? They're always the most quality because of their business model and the way they structured it. And cake's always most quality because they got 2 restaurant chains that have massive growth, and then they just do a phenomenal job operating those, right? Texas Roadhouse is extremely well run. I've always been impressed with Texas Roadhouse, and I have been a shareholder in the past. I just haven't been for like the past year or so. But Texas Roadhouse, that stock's down almost 9% this year. Starbucks, even though that one had already been getting hit, it's getting hit more this year, down about 10%. Chipotle, down 45%, and Cava down 53%. So when it comes to Cava, obviously it's not a stock I own, but I have it on my watch list here. I might possibly buy it. When am I thinking about getting in Cava? Okay, listen, first thing is if I buy Cava, there's always a potential I never buy this stock, but I actually kind of like it. The one thing that scares me with Cava, by the way, is making sure they do a great job with the operations of their restaurants in all these different cities they're going to be expanding into over the next 5-10 years, and making sure they have that unlocked. That's, people assume like, oh, that's just so easy to do. You just build thousands of restaurants and boom, they're up. No. Ask anybody from the restaurant industry. They'll tell you it's brutal to even have 2 or 3 locations and have them be on the same quality levels, right? Never mind having 100, 1,000, 10,000. It's unbelievably challenging to have them all be extremely consistent, right? McDonald's can be consistently average and like they get it done, but it's, like that Big Mac or that double cheeseburger, it doesn't matter if you're in, Atlanta, Georgia, or you're in Huntington Beach, California, like it's going to be the same dang thing, the same taste, right? Chick-fil-A, very good quality at Chick-fil-A, but doesn't matter where you're at. You could be in Charlotte, North Carolina at Chick-fil-A. You could be in Seattle. I don't know if they have Chick-fil-A's in Seattle, but it's going to be the same quality. Cava's got to do that, and that's very difficult to do. As long as I can get more confidence around that, I can start buying the stock. But when will I start buying the stock if I do? I'll tell you exactly when. I would start a position in Cava likely at the beginning of 2026. Here's why, okay? Look at Cava's stock price and what do you see? On a year-to-date basis, on a 6-month basis. Let's pull it back all, okay? We can pull it back all the way to when they went IPO, back here, roughly, right? And then shortly after they went IPO, right here. Then they had this unbelievable run, that really started kind of the end of 2023 all the way into 2024. The stock goes all the way up here. It's insane, right? So then we pull up a 1 year, the stock's down 59%. Year to date, the stock's down 53%. 6 month, the stock is down, if TradingView works, 41% in the past 6 months. The past 3 months, the stock's down 40%. The past 1 month, the stock is down 8%. The past 5 days, the stock is down 17%, right? So what do you think is going to happen with Cava stock? Cava, whatever we want to call it. Here's what's going to happen. You're going to get likely tax loss harvesting in it, especially if their so they're going to report their next quarterly numbers next week, essentially. If that quarter's not good, the stock's going down more, and you'll get an unbelievable kind of avalanche of tax loss harvesting in Cava that will basically go all the way to about Christmas. Brutal. Because people will look at it and they'll be like, the earnings are not good. They could get even worse. The stock's just going down. I need something to write off my Meta gains with, or my Tesla gains, or my Palantir gains, or whatever, right? That they sold for profits. And so they go ahead and sell a position like Cava that's been doing very bad. And remember, the thing about Cava is that's been historically, which isn't a very long history, but like the last couple of years, it had been a very rapidly growing company. Revenue skyrocketing, same-store sales skyrocketing. All of a sudden, that slowed down to a standstill when it comes to same-store sales, right? So now people are going to look. And that's the same, you got to understand, that's the same group that would buy a Cava that would buy a Palantir, that would buy a Snowflake, that would buy, an Amazon or whatever, like growth companies, an AMD and NVIDIA. And so many of the growth companies have been doing unbelievable this year. And if you've taken any profits on those stocks, they're big profits, huge profits. And then you're looking and you're like, crap, the tax man's coming for me in April. What am I going to sell before the end of the year to hopefully offset some of those gains? And then you got a Cava in your portfolio that you're down 58% on, right? And you're like, there it is. Bye-bye, Cava. And then that doesn't mean you stay out of Cava forever. You might come back in Cava in 2026 or 2027 or something like that, right? You're just kind of like peacing out for now. So that's my thing. If I do start a position in Cava, I probably won't start it, honestly, until next year. That's probably what would happen there, right? RH, ooh boy, RH. So that's another one. Look at this. Oh my gosh. Oh, brutal. RH stock year to date is down 55%. Unbelievable how bad that stock is done, right? Absolutely unbelievable. RH, another one that I don't want to go into RH anytime soon. That's another one, like if I'm going to buy RH, it's probably going to be 2026. I'm just like, no, like why would I want an RH right now? Like, that's another one. If people need something to write off some losses against, you own RH, out. The high end of the housing market still not in a good place. Mortgage rates are still not coming down. They're still in the sixes. So, yeah. You got the tariff mess, although that's getting a little more clear. I don't know, man. Like RH, if I would step in RH, it'd probably be next year. Probably be 2026, right? Which that will be a year before you know it. We only got 2 months left in the trading year, and we got the holidays, we got Thanksgiving, and we're about to have Halloween, we got Christmas, we got New Year's. Like this 2 month span just flies by, right? So before you know it, we'll already be in 2026, and maybe I step in on a Cav and an RH. Bath and Body Works. This one, I actually really like it. Obviously, it's not the most amazing, like, growth business model, but it's just a very consistent, good, profitable beast company when it comes to Bath and Body Works. Check this out. So Bath and Body Works, we're looking at 1000xstocks.com here. Check this out. The stock trades at a forward P of 7, a 2-year forward P of 6. Like, it's unbelievable, right? And yeah, it doesn't have the most revenue growth. Like next year revenue growth probably going to be in the 3 to 4% range. Like, put me to sleep. But you're paying like nothing for this company. And I actually don't think they're like, there's certain companies that if they're at a 7 PE or 6 PE or something like that, I look at them and I'd be very cautious, because I'd be like, wait a minute, what's going on here with this company? Like maybe they're about to get disrupted or something like that. Bath and Body Works, who's going to come in and disrupt them? Like they sell soaps and candles, right? And they have a very successful business doing that in malls all across the United States of America, right? And then they have an online presence as well. Like, there's as much competition in that space as there will ever be in that space, right? Like, who doesn't sell soaps and candles? But at the end of the day, they do it. They do a great job of it. Do a great job running their stores. It's always impressive. Their stores are always in great shape. They always look extremely presentable. Their employees, I've been in Bath and Body Works 100 times probably in the past 10, 15 years. Their employees are always nice, good, take care of you. If they see you have too many soaps in your hand, they help you out, get you a bag. It's an impressive company. Not the most exciting company, but remember also, we've been in a very hyper bull market, right? All these stocks rolling. Eventually, people are going to start looking at value and dividend stocks as soon as the stock market starts to cool, right? And maybe the stock market's already starting to cool, or maybe it starts to cool in 2026, or maybe it doesn't start to cool until 2027. But I can promise you, there will be a time, I can promise you, when people start to look at the value and dividend stocks again, right? And that's when all of a sudden a company like a Bath and Body Works starts to shine again. So, am I in a rush to buy that one? No. Because not like growth is just going to magically skyrocket for the company. It's not that sort of company, right? And I'm like, I got to miss out. Like I got to get FOMO around the stock. And additionally, that's another stock that's perfect for tax loss harvesting. Like, is it not? Like anybody that's bought look at this. Anybody that's bought this stock really in the past several years is down, right? I pulled up a 5-year. Bath & Body Works stock is down 7% the past 5 years, ladies and gentlemen. If you bought this stock at any point in the last 5 years, you're down in it. That can't be good to go into year end, right? That cannot be good to go into year end. So something to keep in mind there. Whirlpool stock. This is another one. 2026, I might buy this one. Another stock that's been obliterated. Look at this. 5-year chart, down 61% on Whirl. 1 year, 30% down. Year to date, 37% down. It's been ugly for Whirlpool. We know no one's been moving, right? Everybody's been staying put. I think that starts to reverse in 2026 and then builds in 2027, 2028, and people start actually moving again. And I think that's going to benefit Whirlpool, not just for like the cool thing about Whirlpool, and this thing that really interests me about Whirlpool, because I don't usually like these like commoditized business models, which appliances is kind of a commoditized business model. But if you're ever going to buy commoditized business models, you want to buy them when those stocks have already been like on a multi-year downtrend and they're just wrecked, right? That's when you want to get in, when everything looks bad in that industry. Then you build your position and then you hold for 2-3 years, right? And then you peace out. When times look great again, that's when you peace out, right? Those are not stocks you really want to hold over a 5 or 10 year span. But if you get in them at the right time and they're just beating down dogs, right? No one wants a piece of them. That's a perfect example. Whirlpool. No one wants Whirlpool stock. No one. No one. And you build that position, and then the company starts to have a multi-year run where their business gets better and better and better, right? Which is, my opinion is Whirlpool's business will be better in 26 than it was in 25. And then 27, I think it will probably be substantially better than 26, right? In 28, it'll be even better. So I think they got a multi-year run that starts in 26 of the business getting better and better. And that's why I'm interested in potentially starting a position in 2026 for that stock. But, I'm not in a rush. I'm not in a rush on a lot of these stocks, these sorts of companies, right? Amazon, is Amazon still a buy tomorrow if the stock goes up $30 a share? Guess what? Yes, it's still a buy. It's absolutely still a buy tomorrow, okay? My Amazon projections, you want to see my Amazon projections? Have I showed you guys those before? I don't know if I have. So let me pull up my Amazon projections here on 1000xstocks.com. So load save companies and Amazon. Load data and watch this. So boom, there's all my data loaded from my Amazon projections. On 1000X now, we have ability, you can just save it. My bull case gets the stock to 500 plus likely in 2029. Right now it's in the 200s, right? Base case has the stock getting to, we can call it low 400s to about $500 a share in 2029. And my bear case on the stock still has a company doing pretty darn well. And the stock still would be probably about a $350 stock plus, right? So it doesn't matter which way you slice it, Amazon is a buy. Cheesecake's a huge buy. I spoke about Cheesecake very in depth. I think on this channel, Jeremy Lefebvre Makes Money, I think on a video I posted like 2 days ago on the channel here. So if you want to hear me talk, in depth about cake, I love that one. Planet, the issue with the Planet, this government just sucks and they keep continuing to be in the way of all these stocks in this industry. If the government can ever get their act together, these stocks could be on a massive multi-year run, but as long as the government stands in their way, it's just a brutal business model, man. Brutal business model when the government's working against you year after year, right? Nike, love Nike at this valuation. It's a beaten down dog stock, right? It's another perfect one that honestly, is it suffering from tax loss harvesting? I think so. I think likely, right? Like if you bought this stock at any point in the last number of years, you're down huge. The only way you made money on Nike stock is if you happen to just buy it in that April dip when it was in the 50s, and that's it. Like that's a very small amount of people have actually made money on Nike stock. Most have lost money on the stock for years, right? And so you need something to write off some gains against. There you go. Adobe, I like Adobe. CRM, I really like CRM. And then Google McDougal, even though it's been moving up and up and up, and that stock's been on fire this past 6 months. Look at the 6-month move on Google McDougal, 76% gain. I'm a happy Google shareholder. That one remains a buy. Let's react to some videos.
Roth, MKM, Rohit, 33.
Hope you guys enjoyed that piece right there, by the way.
$1 billion here in AWS revenue. And, operating income for AWS looking pretty solid, considering the layoffs that they're planning as well. Is this what the street is excited about here?
Yeah, I think the magic number is 20% year-on-year growth. That's the fastest AWS growth we have seen in several quarters, and we expected AWS to accelerate when we heard what.
Not only is that the fastest growth in several quarters, I think that's the fastest. Don't quote me on this, but I think that's the fastest Amazon Web Services growth since like 22. But I could be wrong about that. But I just think it is.
From Google, what we heard from Microsoft, with all the cloud and AI cloud trends. And so the bogey was high. And I feel AWS jumped over a higher bogey. And that's why the stock is up and should stay up into the market tomorrow.
What more do you need to hear, do you think investors need to hear for this to be more than a one-day pop, on the backs of those who were underestimating perhaps AWS? What is a narrative shift going to have to consist of if the stock is going to continue to climb from here?
I think it's about the combination of capex and their leading indicator. They'll probably talk about both capex and performance obligations. AWS has reported RPO, the leading indicator in cloud growth, accelerating over the last few quarters. How fast that's growing is something that I would keep an eye on the call. The wider the gap between revenue growth and RPO growth this quarter, greater, more bullish people will be. And second is obviously CapEx. They are at about $120 billion in trailing 12-month CapEx, and how high that goes. Next year, Street is around $128 billion. That number already feels a bit too conservative.
Yep.
How high that CapEx number are they willing to drive? Clearly, it's going to be higher. Whether they give any indicators may put a damper on the stock near term. But again, they are the leading cloud company, and I think accelerating growth is probably putting a lot of kind of bearish narrative to rest.
No, to push back against what that gentleman just said there, listen, he's basically kind of making a case that, maybe investors might sell the stock if Amazon has bigger CapEx numbers and those sorts of things, and kind of could hurt the stock price short term. Listen, in regards to Amazon, no. Like, that company, they get a pass on spending. People trust Amazon. Like, if they're going to spend crazy numbers, people trust they're doing it for a good reason. I think Zuckerberg has a little bit more trouble. People, when he starts spending heavy, people question it more often, right? But Amazon, since that company came public back in the 90s, like, people they always give Amazon a pass. Like, they believe, like, if they're spending the money well, and they're going to make way more money off of that spend. So Amazon just always gets a pass.
Holiday quarter, and we have that guidance. If you had told me 10 years ago it would be 18, 19 minutes into an Amazon report looking ahead to Q4, and we wouldn't have talked really about retail yet, I'd have gone, huh? So how much does retail matter here, and the amount of discounting and shipping costs that Amazon's going to have to eat to drive the top line growth there in the season?
I think during Q4, to some extent, they tend to give a wider guidance for operating income that is expected, given the wide range of outcomes typically they see from a retail perspective. Having said that, I think retail is in this kind of a long-term shift of profitable growth. We started that at some point in 24, and that kind of continuous shift in controlled investment and ongoing improvement in profitability driven by advertising and retail, that has just started. So we like profitable growth in retail and plus accelerating growth in AWS.
How do you read the...
So something I've been thinking about recently is OpenAI, and they're going to push hard into e-commerce, it looks like, in 2026 and beyond, right? And we see all the partnership with PayPal to help run payments and use them as a digital wallet, all that good stuff, right? But I was trying to think, like, could OpenAI disrupt Amazon or Shopify? And because those are two stocks I own. Amazon's a massive position for me in the public count, and I think it's the third biggest position. And then additionally, Amazon is a substantial position in the Patreon portfolio, in my private portfolios. And then when it comes to Shopify, that's a big position for me in the Patreon portfolio. So I was trying to think about that. And at the end of the day, what I see with OpenAI and them pushing into commerce, I think, if anything, that's going to benefit likely Shopify and potentially Amazon, because at the end of the day, like, all those orders have to be fulfilled. And from my understanding, OpenAI is not going to go building massive warehouses and try to house inventory and all that stuff, right? And so I think, if anything, Shopify could benefit big from that. I think Amazon could end up benefiting in the end, and then other companies could benefit as well. But it doesn't look like OpenAI wants to become an Amazon, right? OpenAI has their hands full with spending aggressively for their AI opportunity, right? Like, I don't think all of a sudden they want to start buying land all over the place and building massive warehouses and adding hundreds of thousands of employees. Like, Amazon has over 1 million employees, right?
advertising growth, especially in this environment where targeting and organizations with data seem to be doing better. And I'm thinking about both Meta's results and Alphabet's results in the advertising category yesterday. How does that position Amazon heading into this holiday season versus its competitors?
I think Amazon, in my opinion, is redoing their complete ad stack in a way that...
Oh, come on, Chick-fil-A, just stop it. Oh my gosh. It's not even Halloween. They gave me a Christmas cup today. I thought something looked a little too joyous about this cup. Come on, man. That's just wrong.
About a couple of years back, they were only focused on the bottom of funnel, converting the user who's trying to buy on Amazon, showing them the right ads of the right products at the right time, and hoping that they would buy more of that product. Now, with Prime Video, with Amazon DSP, and a lot of partnerships with companies like Pinterest, Amazon advertising is a much more bigger, complete solution where brands who don't sell on Amazon, think of car manufacturers, think of insurance companies, they consider Amazon as an ad partner because you have Prime Video and you have various different kind of one of the richest cohort of internet consumers looking at your product right now. So I feel they're cracking the problem of advertising in a way that perhaps even Google and Facebook haven't, and they have the data and the AI tailwinds to do even more.
Yeah, Amazon's going to continue to build that ad business out substantially. And the thing you got to understand about the ad business, specifically with Amazon, is that is like a straight profit business. Like that is, ads are always like one of the best business models you could ever be in. Ask Google, ask Meta, right? Incredible. And so that ad business continues to scale and build out. And like I said, that's straight profit business. Additionally, I've been very impressed with like the Thursday Night Football now on Prime. Been very impressed with that. The presentation they're now doing, the whole show they have. Like Amazon's really starting to get it in terms of like putting on broadcasts like that, getting into sports. Obviously, they're not going to get into everything, but you know, a few things here and there, which then they can show ads, continue to build out that ad business, right? Maybe even get people to shop directly through ads, through the TV, through those commercials and things like that. They're doing a lot of innovation when it comes to that. They also showcase Amazon Web Services during those broadcasts because they actually have a way you can watch the game, which is like a totally different way of watching football. You kind of watch it from an aerial view, and it'll basically like show you the routes the players are going to do. And sometimes it even shows you like odds and probabilities, like this guy's going to blitz or this guy's going to do something fascinating. And so they're finding ways to help the e-commerce business build their ad business through this and highlight Amazon Web Services all in one. It's brilliant, absolutely brilliant. So, yeah, I'm very happy Amazon shareholder. Let's talk some Meta stock, eh?
Been listening in. He's the managing partner at Deepwater Asset Management. Gene, I want to start off with Meta. So you think that you figured out why it is down? Why?
Yes, Melissa. I guess the answer was clearly in front of us when those numbers came out and the stock gap down. It's just a simple dynamic between revenue growth and expense growth. And if we rewind to the past 2 years, Meta has grown revenue faster than expenses by a wide margin. 2024 revenue growth about 23%, expense growth about 8%. The first 2 quarters of this year, revenue growth 22%, expense growth 12%. They report their September quarter with 23% revenue growth, but expense growth of 32%. And throwing insult onto that is the commentary about the third-party CapEx spend for next year. And this aggressive is the word that they're spending substantial increase. Expenses related to that. We're probably going to see something like 18% revenue growth for next year for the top line. The street's at 16 right now, but probably 18%, and probably expenses growing north of 30%. And so essentially, the script that we've seen with Meta over the past 2 years got flipped. And I think it's just that simple. If you look across the board at Zuck's ambition around AI, what he's trying to accomplish, look at their engagement. I mean, just like profound engagement growth, accelerating engagement growth. 43% of the world uses their products on a daily basis. Those rate of usage is accelerating. So it was a great quarter with the exception of that dynamic, Melissa, and I think it really stung investors.
Gene.
Okay. Before we go further here, there's something very important that happened for AMD, I thought, in those Meta results. And let me find it. I posted it here in the AMD chat, which is always a busy chat. Let's see, where did I post this thing? This chicken wang. I know I posted in the AMD chat. Where you at? Where you at, baby? Where you at, baby? Come on. I know I posted somewhere here. Let's see. No, I must have posted in the AMD chat. Did I not? I think I posted it here. Oh, right here. There we go. There it is. Okay. From yesterday, I posted at 120. Meta just took the CapEx range for this year up on the low side and said CapEx next year will be notably larger. That was their words, notably larger. Bullish AMD 2026, right? So, but yeah, there's definitely people worried about Meta spend, right? And Zuckerberg going too crazy again with the spend. And listen, it's actually a fair question. That's why I think Zuckerberg's got to get that expense line item under revenue. If they can just grow revenue, like shareholders will have no issue as long as they're just growing that revenue percentage higher than expense profiles going up. If that expense profile keeps going up and revenue's not up as much, that's where people start to throw a fit and say, come on, Zuckerberg.
This is one, again, I saw your notes earlier. You're kind of confounded. Microsoft, similarly. When I look at the downtick in earnings growth, though, for 2026 for Meta, I mean, isn't that the sort of thing that you would probably expect for the stock that's outperformed pretty dramatically, over the last 2 years or so to kind of take a pause?
Well, a pause is understandable, but I think that shift, that expense shift, that was something new. Like a pause to me is they've got good numbers, they beat the numbers. That one-time charge that people are talking about, that $15 million tax charge, that's a nothing. Just throw it out. Doesn't matter. But so I think, Dan, that it's I'm trying to look at like what was incremental. I could understand if the stock was down 3% on good news. That's to me taking a breather. But down 8, 9, 10%. Investors are trying to just recalibrate, I think, something bigger. And again, that dynamic around them going more to cloud. Now, I'd also point out, like around the ambitions and around AI, and I'm all in on this being more transformative than where I think high expectations are. But Zuck basically is setting himself up to be the most optimistic of any of the big tech CEOs, as evidenced by their increase in CapEx. So it's going to be up. The street's looking for 40% growth right now for 26. They didn't give detailed guidance around that, but it's probably going to be up more than 60%. And if you look at what Google just guided up, their CapEx, and apply that to for next year, they're going to be up like 25%, and Microsoft and Amazon around that. And this one comment kind of stuck out to me. He said, we're building our AI infrastructure for the most optimistic, that was his word, the most optimistic case for AI. And I think that's the right thing to do. But that is a little bit unsettling when he talks about the most optimistic case we're building for. And so I think, Dan, that's kind of playing into it. I think it's more than just had a good run and kind of taking a breather. I do think that ultimately he's on the right track. Like I fully support everything that's going on. I think that the stock is going to reverse these losses in the weeks to come.
Oh, no,
Phoenix Karen,
no
thanks
doubt.
for being on. How quickly?
No doubt they're going to buy Meta up. Yeah, and the other thing I'll say about this, I do think significant for everybody that's, wants to be a long-term shareholder of Meta or isn't a long-term shareholder. Listen, something big is going on here. Is Zuckerberg spending a fortune? Yes, no debating. Okay. Look at Meta's revenue growth trend. They just came in with 26% revenue growth. They're one of the only companies in the world that is actually spending aggressively on all these chips and actually getting a great return on investment, and in terms of at least seeing major revenue growth, right? Like you look at Meta's revenue growth ever since, go back all the way to 2023 and look at Meta's revenue growth per quarter, 2023, as that year went along, 2024, 2025. If you want, I'll pull it up right now. Let me pull it up. You wanted me to pull it up? I'll pull it up, okay? Okay, so here's to illustrate this point, right? So we go back to 2021, they had insane revenue growth, obviously Rona, shutdowns, everything like that, right? And weaker numbers in 2020, so they were posting great growth. Well, that growth started to decelerate, right? And then the revenue actually went negative for a little bit there, which was kind of scary. So then you go back to early 2023, they had 2% revenue growth. Then they bumped up to 11%, 23%, right? And they had these very weak numbers to comp against there, so their revenue growth looked phenomenal, right? And then they had 22%, 18%, 20%, 16%, 21%, this latest quarter, 26% revenue growth, right? So we can clearly see there's a trend of Meta's business getting stronger and stronger, and all this spend they've been doing the last 2 years is really starting to show in the numbers in terms of at least revenue growth, right? But they can't let those expenses get too out of line.
The street need to see a return, and how big does that return need to be to justify the spend like this?
Well, we go through the recalibration. That's what's going on now, and it'll happen tomorrow. And then they need to see it in the December quarter in the form of whatever that revenue growth rate is to be higher, a little bit higher than what people are thinking, and then the expenses to be hopefully a little bit lower than what people were thinking. And so, I mean, there's, this is a long-term thing, a long-term opportunity that they're investing into, but they are being marked every quarter. And so I think that they do need to show some improvement. And I think I mentioned earlier this 18% growth for next year for the top line. The street's at 16 for Meta. I mean, it probably needs to be something like 20%, and them showing that in fact this is driving revenue, just like their AI. It's been the best example of any company at scale using AI to accelerate revenue growth, and they need to continue to show that in the December quarter.
No doubt. Alrighty, next one up here, Fast Money Traders Talk Meta.
For more, let's bring in CNBC's Julia Boorstin. Julia, any guidance on 2026 CapEx?
Boorstin.
Well, CapEx is really a big focus of the call right now. CFO Susan Lee talking about it quite a bit. Both she and CEO Mark Zuckerberg talking about why they are raising their CapEx, saying it's all about investing to drive AI strength and how they need to maintain that position of strength. So they raised the range for 2025 capital expenditures to a range of $70 to $72 billion. That's up from a prior range of $66 to $72 billion. And the company did not share specific guidance for next year's CapEx, but CFO Susan Lee just said moments ago on the call about the importance of expanding infrastructure capacity to enable Meta to seize opportunities, saying they expect CapEx dollar growth to be notably larger next year, saying, quote, "We are focused on preserving maximum long-term flexibility to ensure we can meet our future capacity needs while also being able to respond to how the market develops in the years ahead." Now, Lee also saying they expect to invest aggressively to meet those needs, both by building their own infrastructure and by contracting with third-party cloud providers. Now, that could indicate more cloud deals ahead, and Meta has done some big recent cloud deals, a $10 billion deal with Google in August, $14 billion deal with CoreWeave in September, and a $20 billion deal with Oracle in September as well. So, Melissa, now a new category of stocks that might be impacted by all these AI investments.
Yeah, Julia, keep us posted on the call, which is about 38 minutes in. Julia Boorstin. Once upon a time, higher CapEx was rewarded definitively by the stock market. Have we hit a point, Michael, in your view, where we are reassessing? We need to see ROI, and it is the turn here in terms of CapEx numbers.
Yeah, Melissa, I think that's absolutely the case. I think we're going to see more and more of this over the coming quarters. You know, many of these tech stocks, the tech sector in general, was so attractive for so long because it was viewed as CapEx light, and now it's CapEx heavy. You know, it's very similar to like an energy and exploration company within the energy space that constantly has to drill new wells in order to realize growth. These guys are all saying we have to invest ever larger amounts of CapEx in order to keep up with AI growth. And I think the value proposition, once you get to these levels, starts to diminish, and the return on investment becomes much, much harder.
Yeah, Karen.
Yeah, so this is sort of what I was afraid of, that earlier on, CapEx was seen as good. What does the word notably mean here? I don't know. I'm scared
Sounds
of
like
it.
a lot.
I feel like notably is more than 10%. Mm-hmm. That wouldn't be notable to you, would it?
You know, one thing I got to say about what this does for the economy, you know, because I actually think this is substantial. I mentioned this point, okay? Listen, if Meta, Google, all these companies are not spending all that money buying NVIDIA chips and building out massive facilities so they can have all these, deployments of all this technology and whatnot, right? What are they going to spend that money on? I'll tell you what they're going to spend that money on. They're going to spend it on buybacks, right? Buybacks don't really actually do anything for the economy. They don't do anything for the working people, right? But the one good thing I'll say about all this spend on AI is it is something that creates a lot of jobs. Like, you want to talk, these facilities they're building, I don't know if you guys have seen them or looked them up. They're ridiculous, the size of them and the scope, and how many construction workers work on these facilities, right? And how many people make money in all these different ways from these facilities being built. It actually creates an immense amount of jobs. And so that's one thing that I think maybe doesn't get looked at enough, that I'd say, hey man, at least they're actually going to build something with all this stuff, right? They're actually making jobs and creating jobs with all this, right? So, just something to kind of keep in mind there instead of just spending it on buybacks.
I don't know. It seems like more than 10, which is, I think the street was looking for maybe, I don't know, a little over 10%. I think it'll be more than that. I mean, the underlying business is really doing well. They are getting returns. We see growth there, but I don't know that we're getting returns on this kind of spend yet. So it's concerning somewhat. I think we'll hear what they... I feel like they should just rip the Band-Aid off. What do you think the number's going to be?
Right.
Okay, they should tell us what they think the number's going to be for CapEx.
I mean, the backdrop, though, is Meta has always been given sort of the luxury, the benefit of the doubt, because every dollar of CapEx would benefit their own bottom line. But we were talking earlier about, Llama 4. Not so great. So what are the results of all this spending?
Yeah, Meta AI is like a distant behind all those other chatbots that we're seeing right now, and they're trying to fix it. They went out to spend hundreds of millions of dollars. They want to do this research lab. They're kind of saying, don't look here right now, look there. We want to do super intelligence. And, when you talk about what they're getting out of this, obviously, like ad targeting has been really good. I think a lot of the metrics are demonstrating that. At a certain point, you're kind of going to hit a wall, and then they're going to have a lot of competition. If you think about how is OpenAI going to monetize ChatGPT, they're going to get in the digital ad game. Like, that's going to be a big way of how they do it. So you're going to see pressure around the whole space. But the one thing I'd mention about this build out of these data centers, there's just now starting to hit the debt markets, right? And you think about this deal that Meta just did to build this data center in Louisiana. Well, they're basically taking a 20% stake. There's going to, Blue Owl is lending them $27 billion. It's going to go into a special purpose vehicle. And, it's all this stuff, man. And some of that debt is literally going to be issued at 1% above. Like, it's going to be, Mike can get in here, it's going to be like junk. And then it's going to find its way into all these ETFs and all these big, debt portfolios. So all of this stuff is becoming very financialized. And we've been talking about this for a couple of years. These companies have been funding this build out through their cash flow and through their large cash balances. And now it's hitting a wall because 30% of their revenue, it's got to stop at some point, right? So this is, to me, the spot. And Oracle is in the worst spot of all of them. I think their debt to equities are like 500% or something like that. They're going to be the ones holding the bag, then the neo clouds, and then these guys, because they've done this off balance sheet stuff, it's probably going to end up pretty good for them.
Yeah, this is where you get the parallels to the late 90s and early 2000s. You had a tremendous amount of debt issuance going to build out basically the fiber optic network that became Fios and everything else. Now, in fairness, you had companies doing this that really had no business levering up their balance sheet and ultimately went bankrupt. I don't think we're worried about that with respect to the Mag 7 and some of these larger tech companies, but the story still rhymes. And you are starting to see a lot of this debt issuance. You're also starting to see guarantees now from some of these players to smaller, infrastructure companies, construction companies, et cetera. And that's a new thing that we're seeing in the debt markets. Guarantees by Google for someone to build out a data center and issuing debt in order to do that. That's something that's never been done. That always makes me a little bit nervous.
So they took a $16 billion charge. So if they had not taken that, EPS would have been probably 10% better than expected. It would have been $7.25. The street was at about $6.65. They beat revenues by about, I think, 4% better than the street was looking for. Margins are now north of 40%. I get it that people are concerned about the spend. When they go from 69 to 71 billion. To me, that's a bit of a rounding error. But I understand this level that we're looking at now is where we traded down to at the end of July and held. So I actually think you buy Facebook here.
Yeah, so it's funny. He always calls it Facebook. Start calling it Meta. Come on, man. The name's been changed for years now at this point in time. The moral of the story is in regards to Meta, like, even despite the very out of control spend, right? Zuckerberg's got to be up to big stuff here. You know, people question him time and time again, but he always comes through in the end. Does he not? Yes, he always comes through in the end, right? With actual big numbers, like not like he promises something and never comes. No, he says we're going to do this, going to do that, and it ends up becoming the next big thing. So Meta remains a buy, okay? Appreciate y'all for joining me as always. Thanks so much for being here. Pinned comment down there today if you're looking to apply, join Private Stock Group, Private Wealth Group. Get access to thousandxstocks.com. If you join us on a lifetime membership, we'll send you this beauty in there. Ooh, love that card. And then no matter what, when you join us in there, we'll send you your 1000X Steel membership card. It's up a 2025 edition. This is 2024 edition. And then we'll send you your Private Stock Group card as well. This one's beautiful. Put those in your wallet. Bust them out. Show them off. Okay? Much love and have a great day.